The next panel. The next panel is, there's plenty of venture funding for great ideas. Is yours one of them? Well, the session is moderated by Greg Tarr, who is actually pinch hitting, or I should say, pinch moderating in place of Dr. Burton Lee. And the other speakers are Keval Desai, partner of InnerWest Partners, Manu Kumar, founder and chief firestarter, K9 Ventures, Steven Schenkler, managing partner, DN Capital, Ajay Chopra, general partner, Trinity Ventures. Greg? Thank you.
Thank you for having us today. Thank you for coming out on a Saturday morning to join us on this venture capital panel. And we're going to take some questions from the audience about 20, 25 minutes in. So think of your toughest questions for our panel here. And we'll try to keep this casual and have some fun. I'd like to welcome some friends on the end, starting with Ajay from Trinity Ventures. Well-accomplished entrepreneur, very interesting companies, Radium One, et cetera. Steven Schlenker is joining us from DN Capital. We have Manu Kumar from K9 doing some of the early stage seed investments, very involved. And we also have Keval with a very interesting background coming out of Google on the product side. So very diverse panel. I'd like to open it up and get a little background on each of the individuals real briefly, and then we'll kind of dive into the portfolio and what makes successful ventures. Ajay, can you tell us a little bit about your background and how you got into venture?
Yeah, so I'm with Trinity Ventures. Trinity is a 27-year-old venture capital firm focused on early stage investing. So we do what is called seed investing and then Series A, which is typically the first institutional round that comes into a company. We're very active across a variety of different areas. Digital media is a core area for us, cloud, the entire cloud space, infrastructure included. Mobile applications are a key part of our investment strategy, and also social e-commerce. My personal background, I joined Trinity about 6, 7 years ago. Prior to that, I was an entrepreneur. Like many of you, I founded a company called Pinnacle that we took public on NASDAQ and grew it to about $350 million in revenue and then sold it to another public company.
Steven?
Sure. So I'm one of the founding partners of DN Capital. DN Capital is a London, England-based venture capital firm. I set up our US office in 2008. I've been in private equity since I came straight from undergraduate university 22 years ago. So I've been in private equity my whole life, originally working in emerging markets, and then was always involved in the tech space, so making technology investments both in low-tech industries and in technology. DN Capital focuses at the application layer. We only invest in things like digital media, e-commerce, mobile and web applications, enterprise software that's used by business units. And most of what we do is helping companies bridge the Atlantic, so finding opportunities in Europe to bring to the US and US to bring to Europe.
And Manu, what are you up to?
Hi. So I'm actually a geek turned entrepreneur turned investor. I started my career basically in electrical engineering and computer science. I've co-founded 5 companies to date, and decided that I wanted to get more in the investing side, just to go very, very early stage with a focus on core technology or new markets. Some of the companies in my portfolio are companies like Lytro, which is doing a new type of digital camera, Twilio, which is doing cloud communications, and Lyft, which is doing a new form of transportation.
Keval?
Hi guys, I'm Keval Desai. I'm a partner with InnerWest. InnerWest is a 30-plus-year-old venture capital firm here in the Bay Area. We do investments across IT and healthcare. And within IT, we are very heavily focused on mobile, investing across the entire mobile technology stack, from companies like Quantens and Pelican and Envisage that go into smartphones. These are components that go into your phones, to mobile monetization platforms like Tabjoy and Flurry, to consumer apps like Triposo, which is a mobile travel guide that you can use in 8,000 cities across the world, and on your iOS or Android device. We also have a healthcare practice, which is heavily invested in mobile. We have a company called Hippocrates, which is a physician's reference on your cell phone, on your smartphone, so the doctors can walk around and look up drug references as they are giving you care. Personally, I'm a 21-year-old veteran of Silicon Valley. I've been here since '91. I've worked as an engineer, EE undergrad, CS grad, and working on mainframe computers with Tandem, going down the stack. In the last 10 years, probably the most relevant for this discussion is I spent 7 years at Google on the product side. And I'm currently on the board of Flurry and Triposa, which are the mobile companies I mentioned.
Excellent. Thank you, guys. My background, Cross Pacific Capital, we're involved with a company called Glimpse, location sharing, and AdMobius, which is the ex-team from Apple that was working on the iAd. And you know, one of the things in building startup companies that's been a real challenge for me, and I'd love to get some opinions from the panelists, is, you know, how does it all start, Ajay? When you have somebody walk in the door for a seed investment, what are you looking for in terms of the composition of the team? How are you de-risking the investment for your firm?
So, you know, we are fairly structured in the way we look at companies. I don't know whether you know this or not, but there's something like 5,700 companies founded in Silicon Valley each year. And in our practice, we see roughly about maybe 2,500, 2,700 of them. And by the way, we don't look at companies that just come off the transom. We only look at companies that somebody recommends to us. So there's a lot of noise in the ecosystem. So we have fairly defined areas in which we invest. So for example, on the enterprise side, we are primarily focused on front-end SaaS investments. So effectively, things that affect marketing and sales rather than back-end processes. Similarly, in mobile investing, we're looking at very specific sector. We're looking at services more than just applications, for example. We're looking at some infrastructure things that improve the performance. So that's the first cut, where you be very specific about what you're looking for. And then the next thing is, especially in seed investments, all about the entrepreneur. So we want to make sure that somebody you know, has thought through. They don't necessarily need to have experience, because a lot of success stories are with entrepreneurs that are not experienced and are looking at a problem in a completely different way. But they need to have thought about it fairly deeply and have a unique perspective on how the market would evolve and how they would address that market. So those are two things I would say. Be very clear about what you're looking at, have some perspective on what will make it successful, and then bring in entrepreneurs that have given deep thought to the sector.
Stephen, what's your strategy and perspective? You've got some European focus mixed with Silicon Valley. How do you make the magic happen?
So generally speaking, when we're looking at a new team, what we're trying to find, first of all, are people who are looking at a problem and saying, here's something that I really want to solve, not just that I want to be an entrepreneur or that I was unemployable by a big firm or this is my path to millions, but someone who says, this really irks me, this is a real problem, and I have a new way to think about how to solve that. Then within DN, we say, who have we invested with in the past, or who's in our existing portfolio where we think we can help leverage what this team brings to us? There are great opportunities that come to us, and we look at it, and we pass simply because we feel we're the wrong partner, because we don't have the things that can elevate that team to the next platform. Oftentimes that means finding the right people that can be brought in to help on their sales strategy. Sometimes it means bringing some people alongside the technical founders who have specific expertise. And then in our particular case, we're looking for opportunities that we could bring internationally. So it has to be a company that has either within their DNA the belief that they could bring the company to Europe or to Asia, or that they've already got a presence or a customer base that's over there that we can help them leverage.
Manu, can you give us your perspective? Because quite often you're the first money in, you're trying to build the package to maybe bring the deal after 6, 12 months of work to our colleagues here. What goes on in your process?
So for K9, I actually end up investing very, very early. In several cases, I have companies in my portfolio that weren't even companies at the time I started talking to them about investing. That the company was actually incorporated after we'd already had discussions about the financing. And what I look for in companies where I'm going in that early is essentially I'm looking for somebody who is the expert in their field. They truly have to know what they're doing in that particular field, because at this stage, I'm essentially betting on the person and their ability to make the right calls about the market that they're getting into, and their ability to actually build product in there as well. I actually use a set of 5 filters to just kind of trim down what I will actually look at. And they're quite simple. They're essentially, I only work with technical founders. I don't use a sector strategy, so I actually look at, is it core new technology or is it a radically new market? Those are the 2 things that I look for. And then thirdly, I only work with companies that have some kind of a direct revenue model. I don't touch anything related to advertising or media. And 4th and 5th are capital efficiency and companies that are fully located here in the Bay Area. So between those filters, I essentially narrow down what I'm looking at and work with companies at just a very, very early stage.
Keval, what's your perspective kind of jumping into the business recently? You have probably some unique proprietary deal flow with all the Google guys coming out. Of course, they're going to make a beeline to you to have lunch. But some of them aren't going to make the cut and aren't going to be as good an entrepreneur as others. What are you looking for?
Yeah, well, first of all, if they ask me to have lunch, I always insist that we do it at the Google campus because lunch there is fantastic and it's free. So if you haven't tried it, you should all go down and try it in Mountain View. But you know, I look for 3 things. So we look for a very large market, and mobile certainly qualifies when you have 1.2, 1.3 billion people walking around with smartphones in their hands. That's a very big market. Second thing we look for is, as everybody else said here, a top team. A top team to me means that somebody who is not just a domain expert, but somebody who has the perseverance of going through all of the challenges that are going to come your way when you're an entrepreneur. I mean, entrepreneurship is an irrational thing, right? Rational people should not be starting companies because most of the companies fail. But if you're somebody that cannot go to sleep because you're driven by an idea that is so germane to your existence that you have to do it, then that's the kind of person that I'm looking for. And the third thing is what I call a beachhead product. The product that on day one, somebody will use for something. It doesn't have to be the end product that you end up with, but it has to be something that allows you to get some traction. And for mobile companies, we have looked for companies that are mobile first. I mean, it's a cliche now to say that, but what we mean by that is that not a company that was a web company that is now is a mobile app, or a company that was using SEO or SEM for user acquisition is now trying to do the same thing on mobile networks. What I mean is that a company like Triposo did not exist until the smartphone came into existence because it leverages the entire power of the smartphone. Location, time of day, the gyroscope, everything about it. And companies that, again, could not exist unless the smartphone and the tablet came into the world, those are the kind of companies we're looking for. And for the business model, I generally agree with Manu. I mean, even though I come from Google, I think advertising is a hard business model for startups because, especially display advertising, you need lots of eyeballs. And as a startup, you have an audience of 1, the entrepreneur himself. And so e-commerce is my preferred business model because even with 1 or 2 users, you can start monetizing your customer base very quickly. So in a nutshell, we look for large markets, top 1% entrepreneurs, and an interesting beachhead product.
Let me do a quick survey of the audience out here. How many folks in the audience are entrepreneurs? Please raise your hand. Okay, and then of those that didn't raise their hand, how many of you want to become entrepreneurs? Okay, so we have a pretty broad section in focus here, and they might want to know a little bit more about how to interact with folks like you in the venture business. Ajay, our business in venture and even seed investing it's going through a big transition right now. We're seeing a shrinking of the roster at NVCA. What it comes down to, we talked about, is really being able to add value to these companies. We can't just be a finance guy who knows how to do spreadsheets and write a check. How do you and your firm add value, specifically the companies? And give us a specific example or 2.
So I think if you look at the venture business and look at the history over the last several years, at the end of the day, it's probably only maybe a dozen to 2 dozen companies that matter in any given year, right? Those are the ones that become billions of dollars in revenue, not just market valuation. And so the trick in venture is, how do you get to those entrepreneurs that, will make those companies happen? And the important thing there is that it's not about the entrepreneurs coming to us, it's about the venture capitalists going to the entrepreneurs, right? So I call this phenomenon flight to quality. Which means that everybody is looking for those high-quality entrepreneurs that really make a difference, right? And I think the reverse is also true. The entrepreneurs are smart enough. The ones that are going to make those companies are smart enough to know who they want to work with, right? So, and so the matchmaking there is a very interesting dance. And so how do you get an advantage as a venture capitalist, and how do you get an advantage as an entrepreneur? So we can talk about that. I'll give you my quick perspective. So we think of that as a business development activity, which means that we need to build relationships with these entrepreneurs who have a potential to become game-changing very early on, maybe like a year or perhaps even longer than that. So an example of a company that many of you may be familiar with is GMIC, which we actually incubated, in our own offices. Will Harbin, who was the CEO of the company, previously had done a company with us, which was a successful outcome. He was actually not from the Facebook space, Facebook application space, but he had this idea and he matched it with a couple of other entrepreneurs, founded the company about 2.5 years ago, and I don't think I'm betraying anything, but it's going to do more than $150 million in revenue this year. This was a long-standing relationship with an entrepreneur who we knew very well, who understood the space, looked at it from a different perspective, like Manu was saying, had a unique perspective on understanding that space. And we had a proprietary relationship with. That's how the matchmaking usually works. So in our shop, we spend a lot of time incubating companies. This is why we have a seed program, even though we are primarily Series A investors. We have a very robust entrepreneur in residence program where we bring in people as entrepreneurs in residence. And roughly about, I would say, 1/3 of our companies come from completely proprietary sources in any given year. And the remaining 2/3, we look for those high-quality entrepreneurs that I was talking about earlier.
Great. We get a comment from Stephen on the, what are your thoughts on how you've added value with this Europe cross-Atlantic connection? Can you point to a specific company example where you've made a real difference for the entrepreneurs?
Sure. So just before doing that, just a slightly different perspective. As a smaller fund, our funds tend to be sub-$100 million. The vast majority of exits, as I think were pointed out by Ajay, aren't billion-dollar exits. They're often $100 million exits. So you may or may not be one of those people who build out the next Google, the next Twitter. Chances are you probably won't be. From a VC standpoint, if you're not one of the 300, 500, 800 million fund size companies, you don't necessarily have to have the billion-dollar exits to make your return profile for your investors. Every company should have that option value. It should have that potential to be the next billion-dollar company. But depending who you select as the entrepreneur for your VC partner, might have some implications over whether or not that VC will push you to be the billion-dollar company, or whether that VC will continue to let you grow to a potential 100 million exit, and if they see that spark, then bring you to one of the guys who can help you with the 10, 20, $30 million round to be that next big step. So I'll give you an example of that, and also answer, Greg, your original question. We had a company in our portfolio called Shazam, which is mobile music recognition. It's a application a lot of people are aware of now. When we invested, the company was only on feature phones. You had to remember a 9-digit number to type in the US to get an SMS message that said, here's the song you recognize. In Europe, you typed a 4-digit code, 2580. Very little traction. We brought in place 4 of the top 7 executives to supplement the founding team, all through our own networks. We introduced them to a core contact at Apple, so they became an Apple launch partner. Today, they're better known as a US company, although they're still a British company. And they're on about 250 million unique handsets. We've been moving them into the television space. When we first invested, I think people around the table would have been very happy if it was a $30 or $50 million exit. The last round valued them at a much larger multiple than that, and I think everyone now believes it's a $1 billion opportunity. But it was an option value. It was go into a company where we saw core technology, the way that Manu described. We saw an interesting potential for consumer application, and we said, we'll be the player that comes in so that if it gets to 100 million exit, we're happy from our return standpoint, and if it gets that option value, if it actually clicks in, we can then bring it, in this case, to 2 very well-known Sand Hill Road firms to get it to that next stage.
Manu, what's your perspective?
So given how early I'm going into companies, I actually end up working with the companies a lot on product. My background is actually in human-computer interaction, and so I spend a lot of time kind of digging deep on product, digging in on building the team, recruiting, trying to figure out business models, and so just all the stuff that needs to happen in the very, very early stages of the company. Probably the one thing that I don't get as involved in is sales and marketing, because that's just not my strength and not something I enjoy doing. But when you're talking about product, user experience, technology, those are the types of things that I dig into in the companies.
Keval, how is your firm and you individually adding specific value? And give us an example, perhaps with Flurry.
Yeah, Flurry is a good one. I mean, I think, I've been in the Valley for 21 years. I started my company in '99 and went through the venture route. The one big change I've seen in the last, I would say 5 years, is that capital is plenty. There is no dearth of firms or individuals even who can give you a check for $1 million or less or more. So what I think is differentiated now is, as an investor, is that, the number one thing I see in Silicon Valley and probably in the US is war for talent. Every one of our portfolio companies, including Flurry, is looking to hire an engineer and a mobile engineer who can do Android and iOS development. And I don't know if all of you in the audience resonate with this or not, but this is the hardest hiring job of all times, hiring a mobile app developer. There are not enough of them. So the number one thing that I've been doing is just, you mentioned Google earlier. Fortunately, I have an engineering network at Google and other companies that I worked at, and I think number one thing I do for my companies is help them hire top talent, especially in engineering. You mentioned Flurry. Flurry is a much more advanced company now, growing nicely, and they have about close to 100 people now. But one of the person that I hired into Flurry was a ex head of ad sales from Google who has about 25 years of experience selling television ad inventory, believe it or not. He was a chief operating officer at MTV Networks. And he was brought into Google, and then we just introduced him to Flurry, and he just accepted. So he's going to help Flurry go into the display advertising market and help them get deals with the larger companies like CBS and Viacom, and even folks like Nike and AT&T, who are looking at the mobile platform as their next generation for customer acquisition and display advertising. So I think the number one thing that I do for my companies is help them hire great talent.
And so a follow-up question on that, Keval. I'm spending 50% of my time recruiting in this war for talent for my companies. How much percentage of time are you spending right now?
I think once I'm on the board, it's about 80% of my time is on recruiting. I mean, recruiting is everything. Hiring is priority number one for the entrepreneur and the CEO, and so it is for the board member.
Manu, how much time are you spending building out the founding team and so forth, as opposed to technology?
For me, I wouldn't say it's high as 80%, because usually when I'm investing in a company, I only invest in teams that are actually capable of building their own product. Mm-hmm. So that's kind of one of the fundamental requirements that I look at before I will invest in a company. For me, in most cases, the founding team has what it needs to actually build the product. And it's more of a question of figuring out, are they building the right product? And once they build the right product, then at the next stage, once they actually go out and raise more money, that's when the recruiting battle starts. So.
Stephen, what percentage of your time spent on recruiting?
So the percentage of time that I spend with my portfolio companies, it's got to be close to 40 to 50%. The rest is either strategy or new market entry.
Okay. Ajay, recruiting?
Yeah, we spend a lot of time on team building, especially in the early stages. I don't know what percentage, but probably it'll be maybe 60%, 65%. We have a pretty structured way of reviewing all the portfolio company needs every month. I want to go back to one thing, though. I think that this business is shifting towards building a very tight personal relationship with your CEOs and investors, in a way which I don't think was true 5 or 6 years ago. And which is highly differentiated for a lot of companies and actually a lot of investors. So I'll just give you one example, which might be somewhat humorous. My partner Gus Tai invested in a company called Connected. Sachin Rekhi was the CEO. The company got acquired by LinkedIn, probably a little bit too early, but they did all right. But he actually ended up being the minister at Sachin's wedding. He married Sachin and Ada Chen. So you can see the high level of personal relationship. I think when the entrepreneur should realize that all the way from where Manu gets engaged, and I love Manu's portfolio. We have been co-investors in a couple of his companies. He's what I call pre-seed, like very, very early. this is the personal relationship. It's like getting married for like 7 or 8 years. I mean, most marriages don't last that long, right? So it's a very tight relationship that entrepreneurs and investors have to build with each other for these companies to be successful. There has to be a lot of trust.
And let me dig into that a little deeper it's a tough business, and certainly when you're involved on the board of directors with a number of these companies, we go through a lot of stress and hand-holding with the founders as these companies evolve and pivot and so forth. Can you share an example of how you've dealt with tense situations with founders where they were at a pivot point and they had to make some really difficult changes to the management team, to the product, and there's a lot of stress involved here with lack of resources. Can you share an example of how you've handled that?
Are you asking me?
Yeah.
Yeah, it's, in my opinion, it all starts with trust. There is a company that actually Manu and I are both engaged with, I probably won't mention the name, where the CEO did an excellent job in the very early stages, and we were concerned about the scaling of the company with his leadership. Terrific entrepreneur, by the way. Heart was in the right place, passionate about the business, but just didn't have the experience to scale the company in the enterprise direction that sort of ended up going. And we, as a board, with a couple of other investors too, decided to make a change. And took a while. I took him out to dinner, had long discussions with him, got him to actually agree to make the transition. Unfortunately, 6 or 8 months later, we realized that we had made a mistake as investors, which, by the way, a lot of investors will not admit, because the person that we got in was high spender, was taking the company in the wrong direction. And we actually went back to the founder and we said, hey, listen, we were mistaken about the approach that you want to take. How about if we learn the best lessons from what this new CEO tried to do, but you implement it for us in the frugal entrepreneurial way that you were going to do, right, to begin with. And now that company is very nicely back on track under his leadership. So the reason I give this example is because of the trust that we built with him. We could go through the difficult task of replacing him, making him the chairman of the company for that period, and then actually ask him to step back in without hesitation, because there was a possibility of a frank dialogue because of that trust.
Stephen, do you have an example? I know Shazam is not a young company. It's been around for a while. Other companies where you've had some difficult changes to make at the board level?
So there's one company we sold to Oracle last year. We actually sold 2 to Oracle, but this was not the big one that most people were aware of. And the company had gone very close to failing about 3 years ago. It was less than a month of cash on hand. And the founder had basically stepped back, and we were trying to find, should we keep the company going or should we close it down? We had put into the company, as I think the first hire, a mid-level finance guy who actually had a lot more potential than that, and we were sort of grooming him. And by the time the company got into trouble, he was probably effectively COO for the business. And we sat down with him and said, the only way we're going to make this work is if we promote you, make you the CEO, and give you the reins. Are you up for the challenge? And the first quarter that we had him on board, he sold more than the company had in the last 18 months. And within the first year, he had done more than the company had done since its inception. And then it doubled its revenue for 3 years in a row before Oracle finally bought them. So in this case, we had backed a founder who was over his head. The founder admitted that he was over his head, but didn't know what to do about it. We had brought in a co-investor who was ready to throw in the towel, and we basically had to look around and say, is this worth saving or not? And I think that's the hardest thing for VCs to do. It's very easy to throw good money after bad, and it's very easy to throw out the towel when it actually could be saved. And in this case, we got lucky. We backed the right guy, and we were able to get a great exit.
Manu, in your situation, you told me you backed single founders before, and in some cases you might be comfortable, but other cases you might say, boy, he really needs a second or a third co-founder. And that's a tense discussion. You're talking about a lot of founders' equity. How have you managed some of those situations where there's a little tension?
Sure. So let me address your question first. I've actually backed several companies which have had just a single founder. And having a single founder company is usually something that most investors are too afraid to get into because of the high risk involved in that situation. It does require giving up significant chunks of equity to attract more people into the company. However, what we've come up with is this notion of that the people you're bringing into the company at that level, they're somewhere between a founder and an engineer. They're getting much higher stakes of equity than just an engineer would, but it's not the same as if they were starting the company on day zero with the other person, right? And so typically, and the term that I use for describing that position is what we call kind of a founding engineer, where it's somewhere between a founder and somewhere between an engineer. And the amount of equity that we give out also is relative to that, where it's somewhere between a founder and somewhere between an engineer, usually like high single digits to low double digits type of equity in that situation. But I also wanted to go back to kind of the situation that you were talking about, where like board situations where you're trying to deal with with a company. So my background is coming from academia, where I was basically doing a PhD. And in a lot of cases, I actually look at the relationship between a founder and an investor needs to be very similar to the relationship between a PhD student and the PhD student advisor. Right? And the key element there is that the time that you actually get a PhD is when you know more about the subject than your advisor does. Right? That's kind of the defining moment. And likewise, for any good founder, the investors don't know your business. Right? It's up to the founders to actually go out and figure out their business and make it work. And the investors are purely acting on the basis of the information that the founders convey over to them. So that's kind of one of the main principles that I apply when I'm interacting with founders, is that it's really their job to go figure out their business, and they need to have the latitude to actually go and make mistakes, right? And in some cases, the best lessons will actually come from making those mistakes. Now, and my job is to make sure that even when they're making a mistake, they're not killing themselves or killing the company in the process. You might get hurt and you might need a Band-Aid, but you're not dead. So.
Excellent analogies. Keval, how are you handling and diffusing the situations when you have a number of folks coming at you, either in a late stage company or an early stage company? How are you kind of mentoring them to get them on track?
Well, I think the first thing to remember is that the investor's job is really to be the proverbial, friend, philosopher, and guide. We're not running the company; the entrepreneurs are. If I want to run a company, I should go start one myself, but that's not what I'm doing right now. So, I think if you have that framework, that you're really a coach, you're a sounding board, and sometimes you're the deliverer of the tough message. You're the objective observer of what's going on across the company. If you have that framework, then I think things sort of follow from there. I'll give you one interesting story where we made a non-decision. So we have this company where there's two co-founders, very experienced individuals. Both of them had worked at a very large internet public company, not Google, one of the other two. And they started the company about 4 years ago at this point. And the company was very successful from the very beginning. And these two co-founders had, because they had worked together in the past, had done everything that was sort of, that needed to be done in terms of equity split, management authorities, responsibilities. Everything was done very collaboratively and through discussion. Well, it turned out, one day they show up into our offices and say to us, we're on the board, and they say, hey, we can't work with each other anymore. And you got to pick one of us as the CEO. And this is like, if you're parents, you have kids, imagine two of your kids coming to you and saying, pick me. And of course, as a parent, you say, well, we love you both. We don't want to pick. What are you talking? What happened? And that started a string of revelations about, we had these issues and we had this, now but you had these issues 4 years ago. What happened? Turns out they couldn't find a way, and these were both people who were adults, married themselves, with kids themselves. So it was an interesting situation where two adult people couldn't come to a resolution on a point of opinion. Anyways, we told them, look, we're not going to pick. Why don't you go and talk to your own management team, your employees? Because ultimately, who becomes the CEO is going to have a huge impact on people who come to work every day in your company. So go talk to them. And what we did is we offered them a coach, an external a person who's not on the board, who's not associated with the company or with our firm, but somebody who's a professional coach, and there are people like that who exist, and just use that person to do a survey of your employee base, talk to your executives, come to a decision. And so we made a non-decision, but facilitated a dialogue within the company, and they picked one. And because it was very clear based on talking to the employees who they thought was going to be the most effective leader. anyway, that was an interesting one where we didn't really want to make a call, frankly.
That's a tough one. So I'd like to alert the audience. We're going to start taking questions here after the next one last round of questions here. If you guys have any questions, there's a microphone in the front if you are not shy. And you can also send a tweet or two. We'll try to pull off a few there. But give us about 2 minutes. We'll come back for some questions. Ajay, question for you. When these entrepreneurs are seeking advice as to how to be successful from the seed all the way through Series A, what's your general advice when you're on the cocktail party circuit giving advice on startups? People admire, the success you've had. What do you tell them? What's your 2-minute sort of soundbite as to folks trying to build a company and be successful?
Well, I mean, I don't want to dissuade entrepreneurs from pursuing their passion, but I try to be realistic. Entrepreneurship is hard, right? This is not something that you do. I think somebody else mentioned that earlier. This is not something that you do easily or casually. It's very easy for venture capitalists to put our money. It's just money. But for an entrepreneur, it's their valuable time, and related to that, it's their opportunity cost, right? So the most important thing that I tell entrepreneurs is make sure you develop enough conviction to convince yourself that for the next 5, perhaps 7 years, you're going to pursue whatever it is that your passion is telling you to do. I think that many people kind of look at outside trends and kind of like say, okay, mobile and social, let's just go do something in mobile and social. Well, that's a bad idea. I think you have to sort of look for much more deeper sense of conviction that comes from within, right? And I meet with several entrepreneurs on an informal basis, even before they're looking for investments, and I'm sure that's true for many of us. And I often just tell them, look, I just don't see that conviction. I don't think you've convinced yourself. You're trying to convince me, but I don't think you've convinced yourself that you're going to spend 5 to 7 years to build this idea and have a fulfillment at the end of that period. So go away and work on it some more or change your idea. That's typically the first thing I tell entrepreneurs when they're starting out.
Stephen, you've obviously been through a number of investments. What pattern recognition sometimes helps. What kind of advice are you giving folks when they come to you for an early stage investment partnership?
So I think the first and foremost advice, Ajay had some good points, really good points, but I would say have something that's relevant to you. Don't come to a VC having been, let's say, a coder in the gaming space and say, I think there's a great opportunity in fashion e-commerce. If it's completely irrelevant to you, we're going to look at you and say, okay, how do you come to this conclusion? Why do we believe you're going to have that hidden advantage over the next person who comes to us to make that successful? So choose something that you've noticed in your life, in your work experience, that is a pain point that you personally deal with, and then bring it to us and say, here's how you're going to solve that pain point. The other thing is try to find something that causes pain for a lot of people. So it's not just for you, but something that really irritates and annoys a lot of people, regardless of what the industry structure looks like today. You look at Uber and companies like that, it's really annoying waiting around in the rain for a taxi. And yeah, there's regulation, but regulation shouldn't necessarily limit your desire to start up a breakthrough technology company. So think in that sort of sense. What annoys me, what annoys lots of people, and how can I come up with a way that solves people's pain?
Manu, what's your perspective? And I'm going to pick off one question that came up, which somebody in the audience asked, why is it more risky to have a single founder in a startup company? So if you could address that.
So I actually am willing to fund solo founders, so that question is probably better addressed by others. But I would guess that it's mostly because entrepreneurship is hard, as Ajay said. You go through a lot of ups and downs, and when you have a co-founder, your co-founder actually gets to share those ups and downs with you, right? The co-founder is acting as a dampening function, right? Otherwise, you have these peaks and valleys which are just so severe that you can't hang on to the roller coaster. Right?
Would you compare that to having a spouse?
Yes, it's very much like a spouse. Yeah.
Keval?
On the single founder question? Yeah, I mean, I think, as Manu said, I mean, it is a very, life is hard. Life is even harder as an entrepreneur, and it can be the highest of the highs and the lowest of the lows. And you want a partner in crime that allows you to be more balanced when you look at every decision. Entrepreneurs make a lot of decisions every single day, and it can wear on you if you're the only one making the decisions. So, you know, we don't have anything against single entrepreneur, single founder companies. It's just that, as Manu said, we would like to find them a partner very quickly who can either complement them or extend their sphere of influence. But generally, it's just like everything in life. If you're doing it alone, it's much harder. And frankly, if you have a co-founder who is equally or more capable, there is a sign there that somebody else besides you believes in this idea and believes that it's worth 7 years of their life as well to contribute to it. And that's a good sign. When you have 2, you'll have 3, and then you'll have 30, and you'll have 300.
You know, one thing, just quickly.
Go ahead, Ajay.
I'm sorry. I just want to mention is that in a couple of cases we have had single entrepreneurs in the early stages, I strongly recommend for them to bring on an independent board member, hopefully from the industry, who they choose. So it's a confidant for them that they can, you know, sort of go through these issues, you know, outside of the sort of investor board members, you know, who sometimes, you know, are looked upon as differently by entrepreneurs. I'm sorry, Manu, I was interrupted.
I was just going to underscore that when we all talk about that, starting up is hard and entrepreneurship is hard, what we're really referring to is it's an emotional roller coaster, right? It's not just a roller coaster like of all the other things. You're saying, you just go through these highs and lows of emotions, and that's what gets hard to deal with.
So I'm going to open it up for questions. I have a couple up here, but does anybody want to come to the mic and ask a question? Gentleman in the front.
I'm a little shy. So the question is, how close should a business be for you guys to be comfortable investing in it from a radius perspective? So let's say, I'm asking this question because I'm from Chicago, and a lot of times when we talk to VCs in Silicon Valley, they say, well, you're in Chicago, I don't know, maybe. So what's a comfortable radius for you guys?
Ajay, you want to start, and we'll get a quick answer.
Yeah,
for
I mean,
everybody?
we invest throughout the U.S., so Chicago is no problem for us. You know, I also had an investment in China. I just want to mention because it may be relevant to this conference. Although we are not that focused on Asia right now. It was a successful company, 21 VNet Group, that went public last year, based in Beijing. But we are throughout the U.S. So I would say our radius is largely the U.S.
Stephen, real quickly, what's your radius?
On average, Europeans tend to have a broader radius because their local markets are quite small. So we do a lot in Germany, out of the UK. We've done deals on the East Coast and the West Coast. I would say it's also stage specific. The more mature the company is, the broader the radius. When it's really getting started, backyard's much better.
And Manu, to you, getting involved at seed stage, how close in mileage will you go?
So I'll first give the quip answer, which is my radius is 30 miles around Stanford University. Okay. I will not invest in a company that is outside of that area in most cases. And I'll qualify that by actually explaining that I actually did my 2 startups out of Pittsburgh, Pennsylvania, where I was at Carnegie Mellon as an undergrad and for my master's. And then I moved here later on in 2000, several years after my companies had already been successful. But when I moved here, I realized that there's something that happens in the Valley that simply doesn't happen anywhere else. There's a serendipity to the Bay Area that doesn't exist in any other ecosystem to the extent that it does over here. So I actually have a long blog post about this on my website as well, but I only invest in companies that are based right here in the Bay Area, and in fact, I want the entire team to be based over here with no outsourcing, no offshoring, no remote teams or anything like that.
Kival, real quickly, what's your
Yeah,
opinion?
so 80% of our investments are in the Bay Area, about 20% rest of the U.S. We do have a couple of companies in outside of the U.S. The good news for Chicago is that NEA, which is one of the large successful venture firms, just opened a Chicago office. So if you are specifically based there, you may want to talk to them.
Yeah, absolutely. Let's try to pick off a couple more questions here. Keep it real tight and brief because we're out of time.
Okay, thank you. My name is Felisa Ding, and I just graduated from Carnegie Mellon University, and I'm an entrepreneur here. And I think you just answered my question, but I mean, for other venture investors, will you invest a team, sourcing their technology group in China or other countries? Thanks.
Outside the United States is the question. So we have a yes or a no, real
I
quickly.
came from China, so I know a lot of the like a high-tech people, like high-tech group. They have like a good skill, but they are based in China or other Asian countries. So my
Okay.
question.
Let's get a quick yes or no
You know,
on.
many of our companies have development teams based elsewhere, so China, India, Eastern Europe. So we prefer to have, especially for early stage companies where we are focused, we prefer to have the management teams and the marketing operations here if they're going to become global companies. That's our current stance.
Stephen, the answer is probably yes, isn't it?
If we do an e-commerce deal, then we don't mind if the technology is outsourced, provided there's someone in the team itself who has experience managing an outsourced team, that we don't have to bring in someone to manage the outsourced team. If it's something that's more deeper technology, enterprise software otherwise, we'd prefer not to.
Let's move to the next question real quickly. Please keep your questions tight.
It's somewhat related. Are immigration policies one of the reasons why you prefer to invest in teams that are based here? Because all of you mentioned that finding talent is very hard.
Keval, you want to take that?
Yeah, I mean, I think we look for talent wherever it's available, and some of our portfolio companies are certainly hiring outside the U.S., in Asia, in China, in Europe as well, including companies like Flurry, for example. I think the bigger thing I would say is not about immigration policy, which is not a subject that I'm an expert on, but it's more about retraining. I think that if you think about this issue that we have 8-9% unemployment in the US and probably more in Europe, Western Europe, and then you have every one of our portfolio companies who are looking for talent that they cannot fill. I think the issue is training, and I don't know why it doesn't get talked about enough in either the business or the public discourse. If everybody could learn to code, we would have a pretty full economy with pretty healthy employment rates.
Let's move to the next question real quickly here. Until we get the hook, we'll keep going with more questions here. Go ahead.
If you came across a mobile development company, a services company, that has super rich talent, that has proven themselves, made apps like Path and Threadflip and Hipster, that wants to become a product company now, experimenting with their own ideas, would you be willing to invest in this company?
You want to take that one, Stephen?
Yeah, actually, we did have something very similar where we backed the person who developed the Shazam mobile app, and he said, I want to build a product company, but in order to fund the business, I'm going to do some services. We just sold the services side of the business to Thompson and made a lot of money, and then have redeployed some of that money into building out a specific product. I think services businesses in general have limited history of VCs wanting to back them, but product businesses, of course. So the answer is probably yes.
One last question, unfortunately, we have time for. Gentlemen, please, real quickly. We'll squeeze it in.
Hi, my name is Charanjit. I actually had questions around investments in financial technology space. I wanted to know, how does the panel view that particular sector? And number two, what would you look for a team or a startup which is in its early stages before you decide to make an investment in that?
Manu, you want to give us an opinion on that sector?
Most of the fintech deals don't end up having a lot of core tech type stuff in it, so it's not my forte, basically. So
Ajay?
I'll pass to somebody else.
Yeah, I mean, we have a partner who looks at fintech deals. We're pretty selective in that sector because it is pretty crowded and difficult to get early traction on, but we definitely look at it.
Keval, how was your opinion on that?
Well, if you rephrase financial technology as payments, then I think you have a huge number of firms who are interested in that. I did an online payment company as a founder myself in '99. So I think that payments is a very good, large global market. Fintech in general, the issue there has been that there are very few buyers. If you think about the number of people who are the large banks and stock exchanges, if that's your core market, I think that's been hard to sell into. But if the market size is big enough, absolutely, yes.
So we're going to wrap it up here and thank our audience. Thank Keval, Manu, Stephen, Ajay. Very interesting panel, and thank you for attending.
Thank you. Thank you very much, and sorry for the couple questions. I'm sure the panel